Okay, what's up, guys? It's Colin. I had one more request for long options. Again, I don't really buy long options, at least by themselves. Sometimes I'll buy them, in like a put spread or add a long component, but for protection, something like that. But typically, I do naked options and I sell them. And I don't do this, but if I was going to buy options, this is how I would do it. Now, when you buy options, and this is a Apple 117.5 call right now, and it's about June 18th. Just to give you the breakdown, about 31% probability of profit, which is really low. Now, the upside of this, unlimited profitability, and there's a max loss. So if it goes to zero, all the extrinsic value is gone, which will be the day it expires. Then you can only lose that much. With a naked short option, if it just keeps going down or keeps going up in the case of a call, or keeps going down in the case of a put, you could lose a lot more, or have to take the shares a lot lower. So the delta of this is 53, roughly. So that's 53 shares of Apple long. So that's a big delta. So just so you guys know, 100 shares of Apple would be 100 delta. So it's 53 shares of Apple, which is pretty, if you get a nut move, it's going to move. The theta, now one thing important to know when buying options, we have a negative theta here. That means each day, and this is going to increase every day to the point where it's 40 or 50. Maybe not that much, but pretty big at the towards the end of its life cycle, which is June 18th, 2021. So each day you burn $3. Doesn't seem like a lot. It's only $1,100, but after a month or two, this is 5, 6. It's tough. Now the thing with long options, so when you sell an option, you sell it to open at, let's say, $10, and you buy it to close at less, and you keep the difference. Since options always go down because they expire, you have such an edge by selling premium or selling theta, which is time. With a long option only, you buy it to open at this price, and you pray it goes up. Now, you can make unlimited profitability, but here's the thing. Since time is working against you, you have to sell it back higher. So you have to really make money off of the delta only, and you have time working against you, which is literally the biggest disadvantage I can think of. With that said, if I was going to do it, I always buy options at least 8 months out, maybe 7, a year. The further out, the better. You want a surefire way to lose money, buy options using charts 30 or 45 days out. Now, as a premium seller, I sell options about 45 days out because this gives me maximum theta gain. Conversely, if you're buying options 45 days out, you're just going to lose your money unless you're outlier smart or have a grip on this market like no one else. So we buy it out this far. Let's say I really believe in direction and I want to buy a long option, so I'll buy this. Now, how do I manage that? Well, usually if it goes up, even just a couple of 2-3%, I'll take it off, take your profit. Specifically, if you're buying options, if you're in a profit, you should just take it right away, in my opinion. And if this, because it's going to lose money with time, it's just so far out. You can see June 18th here. It's not going to lose too much over, like a couple of months, a month or so. And I really believe in direction, which is why I'd spend this much money on a really low probability, gamble. So what I do, let's say it's a week or 4 days and it goes down 4%. Then I would buy this again in what's called dollar cost average. Now, this can become real dangerous if, the stock doesn't go up eventually. You can just lose more money. One of the misconceptions people have is, well, this option in June 18th, 2021, it's $1,100. I have a bigger risk. Why don't I buy, like a January 15th, it's only $500. Well, your probability of profit is about the same. It's actually 2% higher. But let me show you this. Your delta is less. The theta is like double. So $5 a day that's 1% a day. It doesn't sound like a lot, but here's the thing. If you buy an option and you have to sell it back quicker, let's say you wait 5 days. We just lost 5, 6, 7% because this theta number is going to get bigger. And now you have to not only make that up, but go higher from where you originally were to make any money. It's just a penny. You see how it's such an uphill climb. So people think, oh, well, I only risk $485 versus the $1,100. It's a less risk. It's actually a much greater risk. It just doesn't seem like it. The $1,100 one right here, the theta on this again, it's about half. And so this gives you a chance to dollar cost average. So if I was going to buy a long option, that's how I do it. Typically, if it's over 2, 3, 4, 5%, especially 10, you can make a lot of money on long options. But the most important thing I've learned is you always have to stick to the probabilities. And if I was long an Apple, instead of doing this, what I would do personally, just as an alternative, I would just sell a put. Even if you sell a 110 put, now you're only going to get about $300. Doesn't sound like that much, right? But that's every 45 days or 50 days, right? But you have a 70% probability of profit. I mean, it's literally the exact opposite of the other strategy. So that's what I would do if I was long Apple. And look, now you're burning that almost $5 a day that you just make no matter what. And you get a credit because we're selling options. So that's what I would do. If you're gonna, gamble, in my opinion, with these low probability things, I would at least, maybe another strategy, quickly, is you could sell a put and then also, finance a long call by selling the put, something like this, maybe. And maybe this is called a double long. Maybe you do the 1/15, and then you buy this. You actually get paid $1.53 to buy the call. Oh, give me one second. That's why. So here it is. So they pay you $111. You have some downside risk with the put here. If it goes down, you have to take the shares at 115. 55% probability of profit, which is pretty good, I think, for long options. But let me tell you this: if they take this out, this is 30% probability of profit, burning $5 a day on a $385 option. So it's like 1-2% a day, something like that. So again, if you hold it for 10 days, you're down 15-20%. It's real tough to get that back and get another 5% to make 5%. See where I'm going with this? So I don't recommend it, but my whole thing is selling options, as time is the only real advantage in this game, in my opinion. That's what I would do if I was going to buy an option, though. I would buy it 8 months out, 10 months out, a year out. The further out, the better. And then dollar cost average down is the way to do it. There you go. If you have any other video needs, let me know. Any other ideas. Thanks, guys. Bye.